Well, we have our first global voice on the program, and it's a pleasure, as always, to welcome James Sullivan, Managing Director, Asia Pacific Equity Research at JPMorgan, on the program. James, great to have you with us here. It's always a pleasure. Prashant this side. This big discussion which everyone seems to be having, which is where is this neutral rate? Does it need to be much higher than where we are right now? Weigh in on that, and how important is that for global equity markets?
First off, thanks very much for having me on the program. It's great to be back and spending a bit of the morning with you. So the JPMorgan view on rates right now is, I think, relatively clear. At the end of the day, we are looking for higher rates for a longer period of time. We're not looking for any incremental increases from here, but we are looking for the first rate cuts to be pushed back from the second half of 2004 to early 2025. We think that's very clear, particularly for the U.S., as well, for the Fed, as well as for the ECB. There's a little bit more volatility implied in the Bank of England. But on a broader basis, we are looking at higher for longer. And that's supported by the underlying macroeconomic data. As you indicated earlier in the program, growth in the U.S. remains relatively strong. And that's something that we do think will continue as we look into the second half.
Okay, so rates are going to stay higher for longer. James, thanks for joining us. If growth in the U.S. continues to be strong and equity markets have been strong as well, what is your forecast for the second half of the calendar year in emerging markets like India? Do you see the money come through thick and fast? Because that's been the case so far, barring for a few niggling worries here and there. What's your own prognosis?
So investment is always a choice of alternatives. And I think for India, the key alternative that we've talked about in previous programs is the choice for global investors between India and China as the two most liquid markets in emerging Asia. And I think on that outlook, again, JPMorgan view, I think, is relatively straightforward here. We do see continued growth difficulties in China over the course of the next couple of months, at least. We see the potential for an economic pickup as we enter the fourth quarter of this year and potentially early first quarter of next. But as a result of that, you're seeing very significant outflows across the EM complex, some of the largest that we've seen in years. Contrasting to that, you're still seeing extremely strong inflows from the foreign institutional investors into India to the tune of $1 billion last week and about $23 billion over the course of the last 12 months alone. And so that relative offset is something that we remain very focused on. China economic growth, JPMorgan is currently forecasting 4.8%. That's down from 6.4 at the top of the year. And I would stress the fact that consensus is still at 5.2. So we still see ongoing downgrades for overall China GDP growth relative to where JPMorgan is today. India GDP growth looks relatively steady. We can talk about the inflation outlook in India in a second and the impact that might have. The only other thing that I would throw in from a regional perspective on non-EM is Japan, where we are also continuing to upgrade GDP forecasts. We've gone from about 60 basis points at the top of the year to 1.4% right now. Streets at 1.3, so ongoing upgrade cycle continuing for the overall macroeconomic outlook for Japan. That's probably the biggest competitor from a fund flow perspective as people continue to sell down China and the broader EM complex and rotate into India and potentially, depending on fund mandate, into Japan.
All right. Hi, James. Good morning. This is Nigel on this side. James, with regard to India, what kind of growth estimates are you all penciling in? And also, everything is good at a price, right? Though China has been in a bit of a tizzy. Do you think in the near term, maybe at some point of time, the valuation argument plays in their favor?
So valuation comes to the fore once I can become confident of forward estimates. And because we're still seeing significant downgrades, not only from the macroeconomic perspective, but then down through the stack to the bottoms-up company level as well. And as you had indicated earlier in the program, company guidance remains relatively weak. We're still seeing significant government action against particular sectors. The most recent conversation is regarding the China healthcare sector, where anti-corruption drives have about 184 senior hospital administrators under investigation. That's important from a financial cleanliness perspective, but it does continue to ride herd on overall confidence levels in a market like China. We're not necessarily seeing those issues within India. India, from our perspective, really comes down to sector selection. You're still seeing positive revisions in sectors like PSU banks. You're starting to see negative revisions, however, in sectors like mid-cap IT, textiles, chemicals to some degree. So the sector dispersion is really critical to the asset allocation story for us at JPMorgan within the Indian context.
James, the Indian small cap, sort of, if I can call that an asset class, has been, I would say, maybe the best performing asset class in the world. It's just been incredible at the performance. So, big sort of institutional research teams like JPMorgan, how do you think about that? Because that's a segment which, over the years, over the last 2 decades or so, coverage there from especially big banks like yours has been lesser, right? I mean, it's been expanding. So just wanted your thoughts there, the SMID space in India.
So incrementally, I actually think it's an incredibly important conversation. What we're seeing for broader emerging Asia as a whole is what I would categorize as a transition away from top-down asset allocation to the country level. And in particular, I think this is true in markets where forward economic growth is perhaps more challenging than what we thought 2-3 years ago. So we're moving away from these large-scale asset allocations and really towards a hunt for alpha, a look for bottoms-up idiosyncratic ideas that are not necessarily linked to that more cautious macroeconomic environment. And I've just, in a very long-winded way, explained a small-cap environment. And so we do think that it's an important driver of alpha and investor returns. It is an area where JPMorgan is expanding coverage across multiple Asian markets.
Okay, that's interesting. One last question from my end, James, before we let you go. A very interesting trend that is taking place in the Indian markets is that banks have been under pressure for a while IT has come back, just by virtue of perhaps valuations being a bit more attractive. Would you play the market that way now or for the rest of the year, especially in India?
We'd be, from a sector allocation perspective, we would be more positive on not only the large PSU banks, but also the microfinance names. We are seeing, again, very strong macroeconomic growth, a significant credit impulse, and valuations that, as you just said, are now perhaps more sanguine than they were several months ago. And so we would be more positive on the financial stocks in general at both the large as well as the small cap end.
All right, James, we'll leave it there. It's always a pleasure having you with us here on the program. Thanks very much for joining us on CNBC-TV18. Thank you.